Turn $100 into $1 million. 90% of traders blow their accounts within the first 90 days. Not from bad strategies, from bad behavior. Now listen, turning $100 into $1 million is not fast. Not exciting, not the way you think. Because the traders who actually do this never try to grow the money first. They try to turn themselves into someone who doesn't crack under time. Right now, with $100, you're impatient. You feel like the small size is holding you back. Like you can't really trade yet. Like once the account is bigger, you'll behave better. You won't. The market doesn't change you, it exposes you. If you rush now, you'll rush later. If you bend rules now, you'll justify them later. If you chase now, you'll blow up later. That's why compounding never starts. Because you're obsessed with growth, while the market is testing character. Here's the real test with $100. Can you do nothing and not feel like you're losing? Most traders can't. They trade to feel in control. They trade to feel smart. They trade to feel like today mattered. But compounding doesn't feel like progress. It feels like boredom, like stagnation, like waiting while nothing happens. And that's the price of scale. The traders who turn $100 into $1 million aren't aggressive. They're unbreakable. They don't need action. They don't need validation. They don't need the market to move today. They only need one thing, to show up tomorrow with the same discipline. And tomorrow, and the day after that. That's the real edge. Not leverage, not indicators, not secrets. Just the ability to not ruin a good thing before it has time to grow. If you're honest with yourself, you don't want consistency. You want relief. Relief from being stuck. Relief from feeling behind. Relief from staring at a small account that hasn't changed. So you speed up. You trade more. You size bigger. You look for something to happen. And the market quietly watches you do it. Because speed feels productive. But speed is emotional. Every time you rush a trade, you're not reacting to the chart. You're reacting to pressure. Pressure to prove you're improving. Pressure to justify the time you've spent. Pressure to turn effort into money now. And that pressure kills compounding. Here's why. Compounding requires clean repetition. Same rules. Same risk. Same execution. But when you're in a hurry, repetition feels unbearable. You start thinking, this setup is close enough. I'll just add a little size. I don't want to miss this move. That's not strategy. That's urgency talking. And urgency doesn't scale. The market doesn't reward intensity. It rewards survival over time. You don't blow accounts because of one bad trade. You blow them because speed makes you stack mistakes back to back. One rushed entry, one oversized position, one emotional hold. And suddenly, weeks of discipline disappear in minutes. This is why traders who chase fast growth never experience real compounding. Because compounding needs something they refuse to give it. Time. Time to let edges play out. Time to let probabilities breathe. Time to stay flat when nothing is there. But speed addicts can't wait. Waiting feels like losing. Doing nothing feels like falling behind. So you interfere. And every time you interfere, you reset the clock. That's the part no one tells you. You don't delay compounding by losing money. You delay it by breaking rhythm. Compounding only begins when your behavior becomes predictable. Not to the market, to yourself. When you know, I won't overtrade. I won't chase. I won't break rules under pressure. That trust is what allows size later. That trust is what allows scale. And speed destroys that trust. Because speed is emotional noise. Slow feels wrong at first. Quiet feels unproductive. Boring feels like stagnation. But boring is where compounding is built. The traders who eventually turn $100 into $1 million aren't smarter. They're calmer. They stopped trying to make something happen and started refusing to ruin what was already working. Here's the phase where most traders quietly fail. Not when they lose, not when they're wrong, but when nothing happens. This is where compounding is supposed to work. And this is where you usually break it. With a small account, boredom feels dangerous. No trades means no progress. No movement means no proof. And your brain starts whispering, you're wasting time. You should be doing more. Real traders are active. So you interfere. You take trades that don't fit. You lower your standards. You trade just to feel involved. And every one of those decisions delays compounding. Because compounding only works when your behavior is stable. Not excited. Not motivated. Stable. The traders who turn $100 into $1 million don't win because they trade more. They win because they refuse to break structure during boredom. Think about that. Anyone can follow rules when things are exciting. Anyone can be disciplined during a winning streak. But can you stay disciplined when you've been flat for days? Your account hasn't moved. Nothing feels worth it. That's the real test. Boredom is the market asking, are you going to interfere? Or are you going to let compounding breathe? Most traders can't stand that question. So they answer with action. And action resets the process. Here's the paradox you need to understand. The less you touch a good system, the more it has room to compound. But your ego hates that, because boredom doesn't feel like growth. It feels like stagnation. So you look for confirmation, new indicators, new strategies, new trades, anything to feel productive. But compounding doesn't reward productivity. It rewards restraint over long periods of time. This is why small accounts feel stuck. Not because the edge isn't there, but because the trader keeps stepping on it. If you can't sit through boredom with $100, you won't survive it with $100,000. And without boredom tolerance, compounding never gets a chance to start. This is where compounding almost starts. And this is where most traders ruin it. You finally have a stretch of discipline. You follow your rules. You don't overtrade. You survive boredom. And for the first time, your account starts to move. Nothing crazy, just steady. And that's when the danger appears. Confidence. Not calm confidence. Ego confidence. You start thinking, I've got this now. I'm seeing the market clearly. I can handle a little more risk. This is the most expensive moment in trading. Because compounding is fragile at the beginning, it needs protection. It needs humility. It needs you to act like nothing has changed. But early success tricks you into believing something has changed. So you adjust. You size up early. You bend rules just this once. You take a trade you normally wouldn't. And you don't even feel reckless doing it. You feel deserved. That's how compounding dies. Not in panic. Not in fear. In comfort. Here's the truth most traders miss. The market doesn't punish failure as hard as it punishes premature confidence. Losses make you cautious. Wins make you careless. That's why so many accounts blow up after good periods. The trader didn't change strategies. They changed behavior. They stopped protecting the process and started trusting themselves too much. But compounding doesn't care about your confidence. It only responds to rule consistency over time. The traders who turn $100 into $1 million don't feel excited when things start working. They feel suspicious. They double down on discipline. They tighten rules. They slow down even more. Because they know something you don't yet. The moment you feel safe is the moment you're most vulnerable. Compounding survives only if you treat early success like it could disappear at any moment. Because it can, and it will, if you stop respecting the process that created it. Here's what will surprise you the most. Traders who actually compound to serious money don't feel powerful. They feel contained. Their day-to-day mindset isn't confidence. It's control. They wake up not asking, how much can I make today? But, how do I avoid damaging my edge today? That's the compounding mindset. Because when your goal is $1 million, your biggest enemy isn't losing money. It's breaking character. Millionaire traders obsess over repeatability. They want to know, can I execute this setup when I'm tired? Can I follow rules after a win? Can I do nothing on slow days without forcing trades? They don't need excitement. They don't need validation. They don't need to feel smart. They only need one thing, to behave the same way, regardless of outcome. That's how compounding survives. With $100, this feels pointless. You think, what's the harm? I need to push harder. This doesn't matter yet. But this is exactly where the mindset is built. The traders who reach $1 million don't suddenly become disciplined later. They were disciplined before the money arrived. They treated small capital like a character test, not an opportunity to gamble. This is why their trading feels boring. No emotional spikes, no hero trades, no dramatic swings, just clean execution, over and over. And that boredom? That's compounding in progress. If it feels exciting, it's probably not scalable. If it feels boring, it might finally be working. That's the mental shift. You stop trying to win today. You start protecting tomorrow. And once that happens, size becomes a math problem, not an emotional one. At this stage, most traders think they're doing things right. They've slowed down. They've stopped overtrading. They're trying to be disciplined. But there's one habit still poisoning compounding, and it's subtle. You keep watching the money. Every green day feels like confirmation. Every red day feels like regression. Every flat day feels like failure. And the moment money becomes the scoreboard, compounding starts breaking down. Here's why. Money is emotional feedback. It doesn't tell you whether your behavior is correct. It tells you whether randomness favored you today. When you judge progress by P&L, your brain starts adjusting behavior to feelings, not rules. After a win, you loosen up. After a loss, you hesitate or force trades. After a flat period, you get impatient. None of that is strategy. That's emotional negotiation. And compounding cannot survive negotiation. Compounding needs one thing above all else: behavioral stability. The traders who eventually turn $100 into $1 million Understand this early. Money is a lagging indicator. By the time money grows, the habits that caused it have already been in place for months or years. So instead of asking, how much did I make? They ask, did I follow my rules perfectly? Did I respect risk even when I was bored? Did I avoid interference? Did I behave the same way after wins and losses? Those answers determine whether compounding is alive or dying. With a small account, this feels pointless. You think, if I don't focus on money, what am I even doing this for? But that thinking is exactly why most traders never scale. They want emotional reassurance before compounding has time to work. They want proof too early, and the market doesn't reward early validation. It rewards delayed gratification. Here's the hard truth. The more attention you give money, the less room compounding has to operate. Money-focused traders interfere constantly. Process-focused traders disappear into routine. And routine is where compounding hides. This is why professional traders often feel detached. Not because they don't care, but because they know caring too much creates variance in behavior. And variance kills compounding. If you want to turn $100 into $1, you must stop treating money as feedback and start treating behavior as the only score that matters. Money will follow later, quietly, slowly, and without drama, but only if you stop watching it too closely. This is the phase where compounding quietly loses most traders. Not because they're doing something wrong, but because it feels wrong. You're following rules now. You're controlling risk. You're not forcing trades, and yet, nothing dramatic is happening. Your account isn't exploding. Your results feel average. Some days it feels like you've stalled, and that's when the doubt creeps in. Shouldn't this feel better than before? Why does this feel slower than when I was trading aggressively? Am I even improving? This is where consistency starts to feel like failure. Because consistency doesn't give your ego what it wants. It doesn't give you adrenaline. It doesn't give you stories. It doesn't give you fast feedback. It gives you neutrality. And neutrality is uncomfortable when you're used to emotional swings. Here's the problem most traders don't realize. Your brain is wired to mistake calm for stagnation. When nothing intense is happening, your mind assumes something is wrong. So it looks for problems. You start questioning your edge. You second-guess entries. You wonder if you're being too conservative. And slowly, almost unconsciously, you begin to loosen standards again. Not because you want to gamble, but because you want reassurance. This is why most traders abandon compounding right here. They confuse emotional quiet with lack of progress. But in reality, this is the first time progress is actually happening. Consistency isn't designed to excite you. It's designed to stabilize you. Before money can compound, behavior has to flatten out. Same risk, same execution, same response to wins and losses. That flattening phase feels boring. It feels unimpressive. It feels like you've stopped trying hard enough. But that's an illusion. What you've actually stopped doing is sabotaging yourself. The traders who eventually turn $100 into $1 all pass through this exact stage. And almost all of them say the same thing later. I almost quit when things finally became calm. Because calm doesn't feel like success to a trader trained on volatility and dopamine. But calm is where compounding finally gets room to work. Here's the reframe you need. You're not stuck. You're not falling behind. You're not wasting time. You're building the emotional base required to scale. If you break here, by chasing excitement or forcing growth, you reset the entire process. But if you hold consistency long enough, something subtle shifts. Your reactions soften. Your confidence stabilizes. Your decisions stop fluctuating. And that's when compounding quietly accelerates, without announcing itself. Turning $100 into $1 now doesn't just require discipline. It requires ego starvation. And that's the part almost no one prepares for. Your ego wants evidence. It wants recognition. It wants moments where you feel smarter than the market. Compounding offers none of that. In fact, compounding actively humiliates your ego. No big wins to celebrate. No dramatic recoveries. No trades worth screenshotting. Just quiet execution and long stretches where nothing seems impressive. This is where most traders break. Because they didn't get into trading to feel invisible. They wanted to feel skilled. They wanted to feel ahead. They wanted to feel validated. But compounding doesn't validate you early. It ignores you. And that silence creates a problem. When your ego isn't being fed, it starts negotiating. You've been disciplined long enough. You deserve a little more size. One aggressive trade won't hurt. That's ego looking for proof of importance. And the moment you give it that proof, you fracture compounding. Here's the truth that separates scalable traders from stuck ones. The need to feel impressive is incompatible with compounding. Compounding requires anonymity. It requires being okay with looking average, feeling slow, not standing out. Because the market doesn't pay you for being noticeable. It pays you for being consistent longer than your ego can tolerate. This is why traders who eventually reach $1 often seem boring when you talk to them. They don't tell exciting stories. They don't brag about big trades. They don't frame losses dramatically. Not because they lack confidence, but because confidence for them comes from predictability, not flair. They know exactly how they'll behave. After a win, after a loss, after a dull week. That certainty replaces ego. With a small account, this feels unrewarding. You think, if I'm not feeling smarter, what's the point? But that mindset is exactly what keeps traders stuck. Because the market doesn't reward intelligence displays. It rewards emotional stability under repetition. Turning $100 into $1 means accepting a painful reality. You won't feel like a millionaire trader while you're becoming one. You'll feel restrained. You'll feel muted. You'll feel unseen, and that's not a flaw in the process. That's the cost of compounding. Flat periods are where most traders panic. No gains, no losses, just weeks where the account barely moves. And your first instinct is always the same. Something isn't working, but that instinct is wrong. Flat periods aren't a failure of compounding. They're a requirement for it. This is the part no one explains. Compounding isn't a smooth upward curve. It's long stretches of compression, followed by sudden expansion. But compression feels unbearable when you're starting small. With $100, every flat week feels like wasted time. Every quiet session feels like falling behind. So you interfere. You change setups. You tweak rules. You add trades just to feel momentum. And the moment you do that, you destroy the conditions compounding needs. Here's the reality. Flat periods are where discipline is being tested, not returns. They exist to see if you'll stay consistent without reward. Because if you can't hold your behavior steady when nothing is happening, you won't hold it when size increases. Flat periods strip away motivation. They remove excitement. They leave you alone with your process. That's intentional. The market uses flat periods to filter out traders who depend on stimulation. Only traders who can tolerate emotional neutrality survive long enough to scale. And here's the paradox. The moment you stop trying to escape flat periods, they stop being dangerous. You stop forcing trades. You stop searching for action. You stop mistaking patience for stagnation. Your behavior stabilizes, and that stability is what allows compounding to quietly load in the background. Most traders never experience this phase properly. They keep resetting themselves every time things slow down. New strategy, new rules, new approach. They confuse movement with progress. But progress in compounding looks like nothing changing externally, while everything stabilizes internally. The traders who eventually turn $100 into $1 don't fear flat periods. They expect them. They know flat periods mean risk is controlled. Rules are intact. Emotional volatility is dropping. And that's exactly when compounding is being prepared. You don't grow during flat periods. You qualify for growth. If you can survive them without interference, expansion eventually follows, and when it does, it feels almost anticlimactic. No fireworks. No sudden genius. Just math finally allowed to work. Most traders think compounding comes from good entries. That belief alone keeps them stuck. Because compounding doesn't respond to how often you're right. It responds to how well you control damage when you're wrong. And with a small account, this is where mindset collapses. You feel like tight risk is holding you back. You feel like small losses are slowing growth. You feel like you need to push to make progress. So you loosen risk. You widen stops. You add size. You justify holding losers a little longer. And every one of those decisions tells the market something important. You're not ready to compound. Here's the reality most traders avoid. Compounding begins the moment downside becomes boring. When losses no longer trigger emotion. When red days don't change behavior. When risk feels mechanical instead of personal. That doesn't happen by accident. It happens when risk is defined so tightly that no single trade matters. The traders who turn $100 into $1 obsess over this early. Not because they're fearful, but because they understand leverage doesn't come from aggression. It comes from trust. Trust that you won't panic. Trust that you won't revenge trade. Trust that a loss won't alter execution. Without that trust, size is dangerous. This is why many traders blow up after improving entries. Their analysis gets better, but their risk remains emotional. And emotional risk cannot compound. With $100, this lesson feels frustrating. You think, what's the point of protecting such a small amount? But that question reveals the problem. You're not protecting the money. You're protecting the behavior. Because risk control is behavior under stress. If you can't control downside when the stakes feel small, you won't suddenly gain control when they feel big. Compounding requires losses that feel insignificant, not because they're small in dollars, but because they're expected and accepted. The traders who scale don't avoid losses. They neutralize them. Losses become routine. Stops become automatic. Risk becomes background noise. And once risk fades emotionally, compounding finally has space to operate. Because now, nothing dramatic can knock you off course. And that's stability, not brilliance. Before money can compound, you must become predictable. Not to the market, to yourself. Right now, your reactions change. After a loss, you hesitate. After a win, you loosen rules. During boredom, you force action. That variability is poison to compounding. Because compounding requires one thing above all else: behavioral reliability. The traders who turn $100 into $1 know exactly how they'll behave in every scenario. Not because they're emotionless, but because they've eliminated emotional decision-making. They know how much they'll risk, when they'll stop trading, what they'll do after a loss, what they'll do after a win. Nothing is improvised. Improvisation feels intelligent, but it destroys scalability. Unpredictable traders can't size up safely, because size magnifies whatever already exists. If your behavior fluctuates now, it will explode later. Compounding only begins when your reactions stop changing. At some point in your trading journey, someone told you that flexibility was a strength. They said good traders adapt. They said rigid traders get left behind. They said the market is dynamic, so you must be dynamic too. That advice sounds intelligent. It feels sophisticated. It feels professional. It feels like growth. And it is one of the most destructive ideas you can internalize if your goal is to turn $100 into $1 through compounding. Because most traders don't use flexibility to respond to market structure. They use it to excuse emotional behavior. This is where compounding quietly dies. Not from recklessness, not from ignorance, but from a misunderstanding of what adaptability actually means. Let's be very clear about something most traders never separate. There is a difference between structural adaptation and emotional flexibility. Structural adaptation happens slowly, deliberately, with data. Outside of live trading, emotional flexibility happens in real time, under pressure, driven by discomfort, and compounding cannot survive emotional flexibility. When you're trading a small account, flexibility feels necessary. You think, I have to adjust. This is too slow. I can't trade the same way forever. Conditions are different now. But if you're honest, most of these adjustments don't come from objective analysis. They come from impatience. They come from boredom, from doubt, from the desire to feel like you're doing something intelligent. And this is where traders confuse motion with progress. Every time you adapt because a trade didn't work, you are teaching yourself something dangerous. Rules are negotiable under discomfort. That lesson compounds faster than money ever will. The traders who eventually reach $1 understand something early that others never accept. Compounding requires rigidity where the ego wants freedom. Your rules are not there to be clever. They are there to protect you from yourself. And when you loosen them, even slightly, you create instability. Instability in risk, instability in execution, instability in emotional response. And instability cannot compound. Here's what flexibility looks like in most traders. After a loss, you hesitate on the next setup. After a win, you size up early. During boredom, you expand criteria. None of that is adaptation. That's reaction. And reaction is the opposite of compounding. Compounding requires behavior that does not change in response to short-term outcomes. Because the entire premise of compounding is delayed reward. If your behavior changes before the reward arrives, you reset the process. This is why traders who constantly tweak never build momentum. They think they're refining. They think they're improving. They think they're learning. But in reality, they're never letting any single behavior run long enough to compound. Every time you change the system, you restart the clock. And most traders restart the clock so often that compounding never gets a chance to exist. Here's the uncomfortable truth. The market doesn't reward intelligence displayed in the moment. It rewards consistency sustained over time. And consistency feels stupid to an ego that wants to feel adaptive. This is especially brutal with a small account. With $100, rigidity feels pointless. You think, why be so strict with such little money? I need to be flexible to grow faster. This doesn't matter yet. But this is backwards. The smaller the account, the more important rigidity becomes. Because you are not training your account, you are training your nervous system. You are teaching yourself how you behave under loss, boredom, delay, uncertainty, and flexibility under those conditions teaches instability. That instability scales. When traders finally get more capital, they're shocked at how quickly things fall apart. They think, I was fine with a small account. Why can't I handle size? Because with a small account, flexibility hid the damage. With size, flexibility magnifies it. The traders who compound successfully do something that looks counterintuitive. They remove decision-making during execution. They decide everything in advance. Risk is fixed. Criteria is fixed. Frequency is fixed. Response to outcomes is fixed. Not because they're robotic, but because they understand that the human brain is unreliable under pressure. And compounding doesn't tolerate unreliability. This is why scalable traders often seem boring. They don't talk about reading the market. They don't brag about adaptability. They don't change behavior daily. They repeat. And repetition is the soil compounding grows in. Now let's address the biggest objection your mind is raising right now. But the market changes. Yes, markets evolve. But compounding traders do not adapt emotionally to intraday noise. They adapt structurally, infrequently, and deliberately. They review data over long samples. They test adjustments outside of live risk. They implement changes slowly and then lock them in. What they do not do is react, because reaction feels smart, but it is poison to compounding. If you want to turn $100 into one emitter, you must accept something deeply uncomfortable. You will look rigid. You will feel slow. You will feel behind. And that discomfort will tempt you to change. That temptation is the test. The traders who fail give into it and call it growth. The traders who succeed endure it and call it discipline. And over time, that discipline compounds into something most traders never experience. Behavioral stability so strong that results become inevitable. Not fast, not flashy, but durable. One of the most destructive habits in trading doesn't look destructive at all. In fact, it looks responsible. It looks intelligent. It looks self-aware. It looks like growth. That habit is restarting. Restarting your strategy. Restarting your rules. Restarting your approach after a drawdown. Restarting because something feels off. Most traders don't blow accounts anymore. They do something far worse. They erase compounding before it ever has a chance to show itself. And they do it quietly. Restarting feels productive because it gives you psychological relief. It gives you the feeling of control. It gives you hope. It gives you the illusion of forward motion. But compounding does not survive restarts, because compounding requires unbroken continuity of behavior over time. The moment you restart, you reset the clock. And most traders reset the clock so often that they never accumulate enough time for compounding to exist. Let's talk about how this actually happens. You commit to a process. You define rules. You define risk. You define criteria. At first, things are rough, which you expect. Then things stabilize. Losses shrink. Behavior improves. Emotions calm down. But results don't explode. They plateau. And that's where the trouble begins. Instead of recognizing this plateau as necessary compression, your mind interprets it as a problem. You start thinking, maybe this isn't optimal. Maybe I've outgrown this. Maybe there's something better. And those thoughts feel rational. They sound like maturity. But in reality, they are discomfort talking. Discomfort with waiting. Discomfort with uncertainty. Discomfort with delayed reward. This is where most traders restart. Not because the system failed, but because the ego got restless. Here's the truth most traders never internalize. Compounding doesn't reward improvement. It rewards persistence. You don't get paid for finding better ideas. You get paid for not abandoning working behavior. Restarting breaks that. Every restart wipes out the invisible gains you were building. Emotional conditioning, pattern recognition, reaction control, risk normalization. These things don't show up in P&L immediately, but they are the foundation compounding stands on. And when you restart, you demolish that foundation. This is why traders with years of experience still feel like beginners. They've restarted themselves hundreds of times. New strategies, new rules, new timeframes, new philosophies. Each one feels like progress, but none of them last long enough to compound. Let's be clear about something uncomfortable. Most traders aren't failing because they're wrong. They're failing because they don't stay right long enough. They mistake novelty for improvement, and novelty is addictive. It feels like learning. It feels like upgrading. It feels like momentum. But compounding hates novelty, because novelty resets predictability, and predictability is what allows scale. Think about it this way. Compounding is like training muscle. If you change exercises every week, you stay sore forever. You feel busy, you feel engaged, but you never build strength. Strength requires repeating the same movement long enough for adaptation to occur. Trading is no different. Your nervous system must adapt to risk exposure, drawdowns, flat periods, winning streaks, and adaptation only happens through repetition. When you restart, you interrupt adaptation. You put yourself back into the new phase again, and the new phase always feels exciting. That's why restarting is seductive. But excitement is the opposite of compounding. This is especially dangerous with small accounts. With $100, restarting feels harmless. You think, I'm just experimenting. I'm still learning. This doesn't really count yet. But what you're actually doing is training inconsistency. You are teaching yourself that discomfort is a signal to change, and that lesson compounds. Later, when the money is bigger, you don't suddenly become stable. You become faster at restarting. That's why traders blow up after scaling. They don't trust the process long enough to let variance smooth out. They restart at the first sign of discomfort. The traders who eventually turn $100 into $1 million do something radically different. They stay through boredom, they stay through flat periods, they stay through self-doubt. Not blindly, but deliberately. They understand that compounding is not fragile because of losses. It's fragile because of interruption. A strategy can survive drawdowns. A process can survive bad months. What it cannot survive is constant resetting. This is why professional traders change less than retail traders. Not because they know more, but because they respect continuity. They understand that every change has a cost, and they only pay that cost when the data justifies it, not when emotions demand relief. Here's the mental shift you must make if you want compounding to exist. Stop asking, is this perfect? Start asking, can I run this unchanged for the next 500 trades? If the answer is no, compounding won't happen. Because compounding doesn't require perfection. It requires endurance. Endurance through doubt, boredom, understimulation, slow feedback. Most traders underestimate how long compounding takes to show up. They expect visible results in weeks. But compounding works on a different timeline. It measures how stable your behavior is, how predictable your reactions are, how rarely you interfere. And those things take time to mature. Restarting robs you of that time. Every restart feels like a fresh start, but it's actually a reset to zero. And the market doesn't care how motivated you feel. It only cares whether your behavior remains intact long enough for probabilities to express themselves. This is why some traders with very simple strategies outperform sophisticated ones. They didn't find something magical. They just stopped resetting themselves. They stayed long enough for math to work. Turning $100 into $1 million doesn't require brilliance. It requires something far more rare. The willingness to stay with a boring, uncomfortable, unimpressive process, long after your ego wants to move on. That's compounding, and restarting is its silent killer. There is a cost to compounding that almost nobody warns you about. It's not financial. It's not technical. It's not even emotional in the way most people think. It's social. If you commit to the mindset required to turn $100 into $1 million, you will eventually realize something unsettling. You are walking a path that almost no one around you understands. And that misunderstanding creates pressure. Pressure to explain yourself. Pressure to justify your pace. Pressure to prove that what you're doing is working. That pressure is one of the most common reasons compounding collapses. Because compounding requires you to look unimpressive for a long time. And most people can't tolerate that. In the early stages of trading, everything is loud. You talk about setups. You talk about trades. You talk about wins and losses. There's excitement. There's community. There's constant comparison. And then, if you start doing things correctly, something strange happens. Your trading gets quieter. You trade less. You react less. You stop chasing stories. You no longer have much to say, and silence makes people uncomfortable. Friends ask, why aren't you trading as much anymore? Did you stop? Aren't you missing moves? Online, you see screenshots, big wins, fast flips, aggressive plays. And meanwhile, your account is calm, slow, controlled, unremarkable. This is where compounding starts to isolate you, because you no longer fit the image of what people think a trader should look like. You're not excited. You're not reactive. You're not constantly talking about the market. And that creates doubt, not just in others, but in you. You start questioning yourself, not because your process is broken, but because it doesn't generate social proof. Here's the reality most traders never confront. Compounding is socially unrewarding in the short term. There's no applause for discipline, no recognition for boredom, no validation for staying flat. And if you need external confirmation to stay disciplined, you will eventually break. Because the market doesn't give feedback on your schedule, and people around you don't understand delayed reward. They expect visible progress. They expect momentum. They expect excitement. Compounding offers none of that early. This is why so many traders abandon good behavior. Not because they lose money, but because they feel invisible. They feel like they're falling behind others who look more active, more confident, more successful. And so they do what humans always do under social pressure. They conform. They trade more to feel relevant. They take bigger risks to have something to show. They chase volatility to generate stories. And the moment they do that, compounding breaks. Because compounding is not a performance. It's a private contract with yourself. The traders who eventually turn $100 into $1 million accept something deeply uncomfortable. They will look wrong for a long time. Wrong for being slow, wrong for being quiet, wrong for not participating in every opportunity. They will watch others brag while they wait. They will see screenshots while they log another boring day of execution. And they won't defend themselves. This is one of the hardest psychological shifts in trading. Letting go of the need to explain. Letting go of the need to be understood. Letting go of the need to prove that you're progressing. Because the moment you start trading to satisfy perception, you are no longer trading for compounding. You are trading for approval. And approval-seeking behavior is unstable. It changes with audience. It shifts with comparison. It escalates under insecurity. None of that compounds. The traders who survive this phase develop a different internal reference point. They stop asking, "How do I look?" and start asking, "Is my behavior intact?" They measure days not by outcomes, but by rule adherence. They care less about what others think because they understand something crucial. The people who matter later are not paying attention now. By the time results become obvious, the crowd has moved on to something else. And that's fine. Compounding was never meant to be entertaining. It was meant to be durable. There's another layer to this loneliness that's even harder to deal with. As you progress, you begin to outgrow the conversations you used to have. You no longer want to talk about predictions. You no longer care about what's hot. You no longer argue about indicators. You care about process. And process is boring to most people, so you stop sharing, and that can feel isolating. You start to feel like you're doing this alone. And in a way, you are. Because compounding is not a group activity. It's an individual discipline. The market doesn't care who you know. It doesn't care who agrees with you. It doesn't care who validates you. It only responds to consistency over time. This is why many traders sabotage themselves unconsciously. They reintroduce chaos just to feel connected again. They take bigger risks so they have something to talk about. They trade more frequently to feel in it. And slowly, quietly, they drift away from the very behavior that was working. The traders who make it through this phase do something simple but brutal. They choose isolation over stimulation, not socially withdrawing, but emotionally detaching from comparison. They stop measuring themselves against others' outcomes. They stop consuming content that triggers impatience. They stop needing their trading to be interesting. They accept that compounding is lonely early, so that it doesn't have to be desperate later. Here's the irony. The traders everyone watches and talks about rarely last. They burn bright. They attract attention. They generate stories. And then they disappear. The traders who compound quietly are ignored until they aren't. But by the time people notice, it's already done. The foundation is built. The habits are locked. The emotional volatility is gone. And that's when compounding becomes visible. Not explosive, not dramatic, just undeniable. Turning $100 into $1 million doesn't require you to be impressive in public. It requires you to be disciplined in private. And that means accepting periods where no one understands what you're doing, periods where you feel behind, periods where you wonder if this is even worth it. Those feelings are not signs of failure. They are signs that you are no longer trading for stimulation. You are trading for longevity. And longevity is what compounding demands. If you can survive this social pressure, if you can stay disciplined without applause, you unlock something most traders never experience: freedom from comparison. And once comparison loses its grip, your behavior stabilizes even further. And when behavior stabilizes long enough, math takes over. At some point, every trader believes motivation is the missing piece. You think, if I could just stay motivated, I'd be consistent. If I felt inspired more often, I wouldn't slip. If I believed harder, this would finally work. That belief feels harmless. It feels positive. It feels empowering. It feels like the kind of thing successful people say. And it is one of the most dangerous ideas you can carry if your goal is to turn $100 into $1 million. Because motivation is unreliable. Not occasionally unreliable, structurally unreliable. Motivation is emotional energy, and emotional energy fluctuates by definition. It depends on how recently you've won, how tired you are, how bored you feel, what you've been watching or reading, how you compare yourself to others. And compounding cannot be built on something that fluctuates. This is where most traders unknowingly sabotage themselves. They wait to feel motivated to be disciplined. They wait to feel confident to follow rules. They wait to feel in the zone to execute properly. And when that feeling isn't there, they improvise. They loosen risk. They skip steps. They justify behavior. Then later, when motivation returns, they promise themselves they'll do better. This cycle repeats endlessly, and nothing compounds. Here's the uncomfortable truth. Motivation creates spikes. Compounding requires flat lines. The traders who actually scale do not rely on motivation. In fact, they actively remove it from the equation. They replace motivation with obligation. Obligation doesn't care how you feel. Obligation doesn't rise or fall with confidence. Obligation doesn't negotiate. It simply exists, and that's why it compounds. Let's define this clearly, because most people misunderstand it. Obligation is not punishment. It's not pressure. It's not self-hatred. Obligation is a pre-decided identity. It's the decision that, this is how I behave, regardless of mood. When obligation is present, discipline stops being a struggle. Not because it's easy, but because it's non-negotiable. You don't argue with it. You don't wait to feel ready. You just execute. This is where most traders get confused. They think disciplined traders are more motivated. They're not. They're less emotional. They remove choice from moments where emotion is strongest. They decided in advance how much they risk, when they trade, when they stop, what constitutes a valid setup, how they respond to outcomes. And because those decisions are already made, motivation becomes irrelevant. With a small account, this feels extreme. You think, why be so rigid with such little money? This should be flexible. I'm still learning. I need room to feel things out. But what you're really saying is, I want my emotions to participate. And emotions are the enemy of compounding. The traders who eventually turn $100 into $1 million do not feel motivated most days. They feel neutral. Some days they feel bored. Some days tired. Some days distracted. And none of that matters. Because their behavior does not depend on how they feel. That's the shift. This is why relying on motivation keeps traders stuck. Motivation comes after success for most people, not before. Waiting for it is like waiting for the market to reassure you before you act correctly. The market doesn't work that way. It rewards behavior first. Emotion catches up later. Here's what happens when obligation replaces motivation. Losses stop feeling personal. Wins stop feeling intoxicating. Boredom stops triggering interference. Because you're no longer trading to satisfy a feeling. You're trading to fulfill a standard. And standards compound. Motivation does not. This is also why so many traders fall apart during drawdowns. Their motivation collapses with their confidence. They say, I just don't feel it right now. And that sentence ends compounding. Because compounding doesn't pause when you don't feel it. It resets. The traders who survive drawdowns do not feel inspired. They feel obligated. They show up because that's what they do. Not because it feels good, because it's who they've decided to be. This is why successful traders often sound unemotional when they talk. They're not passionate about trades. They're committed to execution. And commitment outlasts passion every time. There's another layer to this that most people never notice. Motivation feeds ego. When you feel motivated, you feel powerful. And power tempts you to break rules. You take bigger risks. You push frequency. You trust yourself more than the process. Obligation does the opposite. It humbles you. It reminds you that the process is bigger than your current emotional state. And humility is essential for compounding. Because compounding requires you to accept that. You are not special. You are not immune to mistakes. You are not smarter than probability. Motivated traders forget this. Obligated traders remember it daily. That's why obligation feels heavy at first. It removes the emotional highs. It removes the fantasy. It removes the illusion that you can shortcut the process. And that's exactly why it works. The traders who turn 100 into $1 million don't wake up excited to trade. They wake up prepared to behave correctly. They don't ask, do I feel like trading today? They ask, are my conditions met? If yes, they execute. If no, they do nothing. No drama, no internal debate, no emotional roller coaster. This is what compounding actually looks like in real life. Not inspiration, not hustle, not obsession, but quiet obligation, day after day, week after week, month after month. And here's the final shift that changes everything. Once obligation becomes your default, motivation occasionally returns, but now it's harmless. It doesn't control you. It doesn't change behavior. It's just energy on top of discipline. And that's when compounding accelerates. Because now your actions are stable and sustained. Turning $100 into $1 million, doesn't require you to feel driven. It requires you to feel responsible. Responsible for protecting capital. Responsible for following rules. Responsible for not letting emotions decide. That responsibility is not exciting, but it is scalable. And scalability is the only thing that survives long enough for compounding to do its work. Most traders secretly believe one thing, even if they never say it out loud. They believe that big wins are what change everything. They believe one great trade will unlock confidence. One huge day will prove they're on the right path. One breakout win will finally separate them from everyone else. And that belief quietly prevents compounding. Because turning $100 into $1 million does not happen through big wins. It happens through small wins that don't damage your behavior. This is one of the hardest ideas to accept in trading, especially early on. Small wins feel pointless. They feel slow. They feel unimpressive. Big wins feel meaningful. They spike confidence. They create stories. They feel like progress. But big wins carry a hidden cost that most traders never account for. They change how you behave afterward. That behavioral shift is where compounding breaks. Let's talk about what actually happens after a big win. You don't just make money, you feel something. You feel validated. You feel sharp. You feel like you're finally getting it. And that feeling is dangerous. Because confidence gained too quickly does not stabilize, it inflates. After a big win, traders almost always do at least one of the following. They increase size prematurely. They loosen criteria. They trade more frequently. They trust intuition over rules. None of this feels reckless in the moment. It feels earned. And that's exactly why it's lethal to compounding. Compounding does not grow from emotional highs. It grows from behavioral flatness. The traders who eventually turn $100 into $1 million understand something that contradicts intuition. The best win is the one that doesn't change how you trade tomorrow. That sentence alone disqualifies most big wins, because big wins almost always change tomorrow. They change your expectations. They change your risk tolerance. They change your emotional baseline, and compounding cannot operate on a moving baseline. This is why traders who chase big wins often experience violent cycles. Huge up days, followed by reckless trades, followed by drawdowns, followed by frustration. They mistake volatility for progress. But compounding hates volatility in behavior. It wants sameness. This is where small wins become powerful. Small wins do not excite your ego. They do not convince you you've arrived. They do not tempt you to break rules. They reinforce something far more important. Trust in the process. A small win that comes from correct execution tells your brain, this behavior works. A big win often tells your brain, I'm good. Those are very different lessons. One compounds, the other destabilizes. This is why professional traders often sound unimpressed by profits. They don't celebrate outcomes. They evaluate execution quality. Because execution is the only thing that repeats cleanly. A big win might never happen again, but correct execution can happen thousands of times. And compounding requires thousands of repetitions. Now let's talk about the psychological trap that small accounts fall into. With $100, small wins feel meaningless. You think, what's the point of making a few dollars? This won't get me anywhere. I need bigger moves to matter. But that mindset is exactly why small accounts stay small. Because you're training your brain to dismiss correct behavior unless it feels impactful. And compounding requires the opposite. It requires you to reward yourself for discipline, not magnitude. The traders who eventually reach $1 million don't ignore small wins. They respect them. Because small wins prove something critical. That you can execute without emotional disturbance. That you can follow rules without needing excitement. That you can accept incremental progress without forcing acceleration. Those traits scale, big wins don't. Here's a reality most traders never confront. The market does not scale excitement. It scales consistency. If your system produces small, repeatable gains with controlled risk, compounding can work. If your system depends on occasional big wins, compounding becomes fragile. Because big wins are rare by nature. And when traders start depending on rarity, they start forcing trades. That's when behavior breaks. Small wins also do something else that big wins don't. They normalize winning. When you win small and often, without emotional spikes, winning becomes routine. Routine removes pressure. Pressure is what causes traders to sabotage themselves when size increases. This is why traders who only win big occasionally feel intense stress when they scale. They're not used to winning calmly. They associate winning with excitement. And excitement doesn't scale. The traders who compound successfully associate winning with normalcy. A win is just confirmation that the process is intact. No celebration, no escalation. no urgency. That emotional neutrality is what allows size later. Let's look at this from another angle. Imagine two traders. Trader A waits for big wins. Trader B takes small, clean wins. Trader A has dramatic equity swings. Trader B has a slow, steady curve. Trader A feels alive when trading. Trader B feels bored. Now fast forward several years. Trader A has stories. Trader B has capital. Because stories don't compound. Behavior does. Small wins also teach you how to lose properly. When your wins are small, your losses are also small. This keeps emotional balance intact. Big wins often make small losses feel unacceptable. After a big win, traders hate giving anything back. So they hold losers longer. They avoid stops. They wait it out. And suddenly, one loss wipes out multiple wins. That volatility destroys compounding. Small win traders don't have this problem. Losses are expected. Losses are normal. Losses don't feel personal. That acceptance is critical. Because compounding is not about avoiding losses. It's about keeping losses proportionate. Small wins teach proportion. Big wins distort it. This is why so many traders blow up after their best month ever. They didn't get worse. They got emotional. They started protecting ego instead of process. The traders who reach $1 million don't chase best months. They chase unbroken months. Months where behavior stays intact. Months where rules don't bend. Months where nothing dramatic happens. Because drama is the enemy of scale. Here's the hardest part for most traders to accept. Turning $100 into $1 million will feel boring for a very long time. If it feels exciting, something is probably wrong. Small wins don't feel like success. They feel like maintenance. And maintenance is exactly what compounding requires. You are maintaining emotional stability, risk discipline, behavioral consistency. Money grows as a side effect, not as the focus. This is also why traders who focus on percentages instead of dollars progress faster. A 1% gain from correct execution matters more than a lucky 10% spike. Because 1% can be repeated. Luck cannot. The market eventually removes luck. It does not remove discipline. If you want to turn $100 into $1 million, you must rewire what you consider a good trade. A good trade is not the biggest win. A good trade is the one that followed rules, respected risk, didn't change your behavior afterward. That's it. If you can string together thousands of those trades, compounding becomes inevitable. Not fast, not exciting, but inevitable. This is why traders who survive long enough eventually seem unstoppable. They didn't discover something secret. They just stopped needing big wins to feel okay. They let small wins accumulate quietly. And one day, years later, they realize something shocking. They're no longer trying to grow fast. They're trying not to mess up what's already working. That's the final mindset shift. At that point, money stops being the driver. Behavior is. And when behavior leads long enough, money follows. Turning $100 into $1 million doesn't require brilliance. It requires humility. The humility to accept small progress. The humility to reject excitement. The humility to let time do the heavy lifting. Small wins are not stepping stones. They are the path. There is a moment in every trader's journey where impatience disguises itself as confidence. It usually happens after a stretch of decent performance. You've had some wins. Your losses are controlled. Your rules feel familiar. And a quiet thought appears. I'm ready to scale. That thought has ended more trading careers than bad strategies ever have. Because scaling too early does not just increase risk, it exposes unfinished psychology. And unfinished psychology cannot survive size. Turning $100 into $1 million is not about how fast you increase capital. It's about how long you delay increasing size. This is where most traders misunderstand compounding at a fundamental level. They believe compounding means adding size as soon as possible. But compounding actually requires the opposite. You delay size until your behavior is so stable that size becomes irrelevant. Let's talk about what ready to scale actually means and why most traders aren't. When traders say they're ready, they usually mean they've had a few winning weeks. They feel confident. They're bored with small gains. They want results to feel meaningful. None of that qualifies you to scale. In fact, those are warning signs. Because confidence based on outcomes is fragile. And fragile confidence collapses under pressure. Here's the part that hurts to hear. If you feel excited about scaling, you're not ready. Real readiness feels dull. It feels anticlimactic. It feels like size won't change anything emotionally. That emotional neutrality is the signal. But most traders never wait for it. They scale while still emotionally reactive. And size magnifies everything. Small fear becomes panic. Small confidence becomes arrogance. Small impatience becomes recklessness. This is why traders often say, I was doing great until I sized up. They didn't suddenly lose skill. They lost emotional stability because their behavior wasn't finished developing. Scaling is not a reward, it's a stress test. And stress tests reveal weaknesses, not strengths. This is why traders who rush scaling often spiral. They start hesitating after losses. They avoid stops. They revenge trade to get back to even. They watch P&L obsessively. All of those behaviors existed before. Size just made them impossible to ignore. The traders who eventually reach $1 million understand something crucial. They do not scale to make more money. They scale because they no longer react differently when size changes. That's the difference. For them, size is boring. A larger position doesn't make the trade feel more important. It doesn't raise adrenaline. It doesn't change decision-making. That emotional flatness is what makes scaling safe. Now let's talk about why early scaling feels so tempting. With a small account, gains feel symbolic. You think, even if I do everything right, this doesn't change my life. That thought creates pressure. Pressure to accelerate. Pressure to shortcut. Pressure to make trading worth it. And that pressure pushes traders to scale prematurely. But compounding does not respond to urgency. It responds to emotional maturity. If your motivation to scale comes from frustration, impatience, or boredom, you are not scaling from strength. You are scaling from discomfort. And discomfort-driven decisions always backfire. This is where most traders misinterpret discipline. They think discipline is about controlling behavior. It's not. Discipline is about controlling timing, knowing when not to escalate, knowing when to stay small, even when ego wants progress, knowing that delayed size is not wasted time, it is preparation. The traders who successfully turn $100 into $1 million delay scaling far longer than feels reasonable. They stay small through winning streaks. They stay small through confidence spikes. They stay small through boredom. Why? Because they're not testing profitability. They're testing emotional durability. They want to know, can I trade the same way after 10 wins? Can I execute without hesitation after a loss? Can I sit through drawdowns without changing behavior? Can I stay calm when nothing happens for weeks? Once those answers are consistently yes, size becomes safe, not before. Here's a critical insight most traders miss. Scaling is not about money management. It's about self-management. If you don't manage yourself perfectly at small size, you won't manage risk at large size. The traders who blow up after scaling didn't suddenly become reckless. They simply encountered emotions they hadn't trained for. And those emotions were always there. They were just muted by small numbers. This is why paper trading and small accounts can be misleading. They hide the emotional impact of real risk. Scaling introduces emotional weight. And if that weight changes behavior, compounding collapses. This is also why some traders seem slow but unstoppable. They don't rush size. They let time harden their discipline. They wait until discipline feels automatic, until rules feel boring, until execution feels mechanical. That boredom is not a flaw. It's the signal that emotions are no longer driving decisions. Now let's talk about the biggest myth around scaling. The myth is that scaling faster increases learning. It doesn't. It increases noise. Big size creates loud emotions. Loud emotions block learning. They push traders into survival mode. In survival mode, you don't learn, you react. True learning happens when emotions are quiet. That's why staying small longer accelerates growth. It allows you to observe mistakes calmly, correct behavior without panic, reinforce discipline without fear. Scaling too early removes that environment. And once fear enters the picture, progress slows dramatically. This is why traders who reach $1 million often say something surprising. The hardest part wasn't making money. It was not increasing size too early. Because restraint is psychologically harder than aggression. Aggression feels active. Restraint feels passive. But compounding rewards restraint. Another critical point. Scaling does not fix impatience. It amplifies it. If you are frustrated with small gains, larger size will not make you patient. It will make you emotional. If you are bored now, size will not make trading interesting in a healthy way. It will make boredom expensive. The traders who succeed do something counterintuitive. They scale after they no longer care about scaling. When the desire to scale disappears, that's when it's safe. Because now, size is just a number, not a solution, not a validation tool, not a way out. This is why true compounding feels slow early and unstoppable later. The early phase is spent removing emotional weaknesses. The later phase is just math. Most traders reverse this order. They try to use math to solve emotional problems, and it never works. Turning $100 into $1 million requires a specific kind of patience. Not patience with markets, patience with yourself. Patience to let habits solidify. Patience to let boredom do its work. Patience to let confidence stabilize. Scaling is not the milestone. Stability is, and when stability is present long enough, scaling becomes almost boring. No celebration, no excitement. Just another execution. That's when compounding becomes durable. Because now, nothing can knock you off course easily. No win, no loss, no number. At that point, money is no longer the challenge. Time is, and time finally is on your side. Most traders think hope is harmless. They think optimism keeps them going. They think belief is necessary to survive uncertainty. And in normal life, that's often true. But in trading, especially if your goal is to turn $100 into $1 million, hope is not a strength. It's a liability. Because hope replaces responsibility, and compounding only works when responsibility is absolute. This is one of the most uncomfortable truths in trading psychology, and it's why almost no one teaches it this way. Hope feels positive. Hope feels motivating. Hope feels like resilience. But hope is passive. Hope waits. Hope assumes the future will fix what behavior hasn't. And compounding does not reward hope. It rewards ownership. Let's look at how hope actually shows up in trading. You hope a trade comes back. You hope a drawdown recovers. You hope discipline pays off soon. You hope this month is different. Each time you hope, you subtly hand control to the future. You stop acting as if outcomes are fully dependent on behavior. And that's where compounding breaks. Because compounding requires a brutal mindset. Nothing is coming to save me except my consistency. Hope softens that truth. Optimism blurs accountability. Belief delays adjustment. This doesn't mean you become pessimistic. It means you become grounded. The traders who eventually reach $1 million do not hope their way there. They execute their way there. They don't believe things will work out. They behave as if failure is always possible and prepare accordingly. That mindset feels heavy at first because it removes emotional comfort. But emotional comfort is exactly what causes traders to tolerate bad habits. Hope allows rule bending. Hope allows just this once. Hope allows waiting instead of acting. And compounding punishes all of it. Here's where this gets subtle. Most traders don't hope consciously. They don't say, I hope this works. They say things like, it'll probably come back. The odds are still good. I just need a few more wins. This should work eventually. Those statements feel analytical. They're not. They're emotional cushioning. They exist to reduce discomfort. And reducing discomfort without changing behavior is the fastest way to stall progress. This is why traders can stay stuck for years without blowing up. They don't fail dramatically. They hover. They survive. They oscillate. Hope keeps them there. Because hope convinces them that time alone will fix things. But time does not compound by itself. Only behavior repeated without distortion compounds. The traders who reach $1 million eventually lose hope. And that's a good thing. They stop expecting the market to reward effort. They stop expecting patience to be noticed. They stop expecting belief to matter. Instead, they operate under a different assumption. If this works, it'll be because my behavior never broke, not because I believed hard enough. That assumption changes everything. Losses become information. Drawdowns become diagnostics. Flat periods become tests of discipline. There is no emotional bargaining. No waiting for conditions to improve internally. Execution happens regardless. This is why experienced traders often sound cold when they speak. They're not ungrateful. They're not cynical. They've just removed fantasy from the process. Fantasy is expensive. Fantasy creates expectations. Expectations create disappointment. Disappointment leads to interference. Interference kills compounding. Hope is just fantasy wearing a positive mask. Let's talk about optimism specifically. Optimism says, things will work out. That sounds harmless until you realize it subtly encourages complacency. Optimistic traders are slower to cut losses. They tolerate bad behavior longer. They delay hard decisions. They assume the future will smooth things over. Compounding does not smooth mistakes. It amplifies them over time. That's why the most dangerous trader is not the reckless one. It's the hopeful one. The trader who believes they're close. The trader who believes effort deserves reward. The trader who believes time guarantees progress. None of that is true in trading. Progress is conditional. It is earned daily. And hope interferes with that reality. The traders who reach $1 million replace hope with something far more effective. Standards. Standards don't care how you feel. Standards don't soften losses. Standards don't wait for confidence. Standards execute. They create rules that do not bend under discomfort. They create limits that do not negotiate with emotion. They create behavior that does not change because of belief. This is the final psychological shift. You stop hoping to become disciplined. You decide to be disciplined. You stop believing compounding will happen. You act as if compounding is fragile and must be protected daily. You stop expecting results. You expect execution. And execution becomes the only metric that matters. This is where most traders misunderstand confidence. They think confidence comes from believing in themselves. It doesn't. Confidence comes from predictability, from knowing exactly how you will behave under stress, from knowing that no matter what happens, your actions are stable. That confidence is earned, not believed. Hope skips the earning process. It assumes, and assumptions are punished in markets. Let's zoom out and look at the full arc. Turning $100 into $1 million was never about money. Money was just the scoreboard. The real transformation was psychological. You learned to stop rushing, stop forcing, stop restarting, stop scaling early, stop chasing validation, stop relying on emotion. And now, in this final phase, you stop hoping. You accept reality as it is. You accept that markets are indifferent. You accept that outcomes are delayed. You accept that no one is watching. And that acceptance is freedom. Because once hope is gone, pressure disappears. You're no longer waiting for something to happen. You're no longer needing confirmation. You're no longer bargaining with time. You're just executing, day after day, trade after trade, month after month. And that is where compounding finally becomes unstoppable. Not because it accelerates suddenly, but because nothing is left to sabotage it. No impatience, no optimism spikes, no belief-driven risk, no emotional shortcuts, just behavior, locked in, stable, unchanging. At that point, whether you turn $100 into $1 million is no longer a question of if. It becomes a question of how long you can stay intact. And that's the final truth. The market does not reward hope. It does not reward belief. It does not reward optimism. It rewards traders who remove themselves from the equation, who execute without emotional negotiation, who protect the process even when nothing feels rewarding, who understand that compounding is not something you wish into existence. It is something you stop interrupting. Once you reach that point, the hardest work is already done. From there on, money is just math, and math is patient. You don't turn $100 into $1 million by wanting it badly. You do it by becoming someone who no longer needs to want anything from the market. That's the compounding mindset.